the Chairman Levitt has worked with the Financial Accounting Standards Board to encourage the FASB to undertake a project to improve disclosure regarding derivatives, and he has directed the staff to review those disclosures made by companies with respect to the adequacy of their disclosures. He has directed the staff he wrote to the directors of various mutual funds to ensure that they had the right controls in place for the usage of these products. We are working with the members of the securities industry to better establish mechanisms for overseeing the risks of trading by broker-dealer firms and to make sure that we have the right controls in place. Let me just make a nod of my head because I won't try and carry their conversation for them. We are also participants in the President's Working Group on Financial Markets, which is chaired by Undersecretary Newman, the members of which are the Federal Reserve Board, the Commodity Futures Trading Commission, and the SEC. And as such, we are in constant consultation and conversation with them regarding these issues, and the banking agencies and the CFTC are also active in this area with respect to the supervision of their related financial institutions. And that pushes it by 2 minutes, so I will conclude my remarks there and thank you for your attention.
Thank you, Mr. Becker. Would you respond to any questions? Any questions from Mr. Becker? Let me again remind you, please use the mic in the aisle. Anybody have a question for Mr. Becker? Please identify yourself so he knows who he's talking to.
Tony Wickren with Executive Intelligence Review. The recent case in Charles County, Maryland, which was reported in the press last week, which actually began at the beginning of July, according to the lawyers involved, it seems that the central issue is going to be a legal doctrine called ultra vires, which holds that the securities dealers are supposed to be able to understand the legal authority of the government entity with which they're doing business. And it appears very obvious in this case that they didn't bother to do that because Maryland state law says quite explicitly that the local governments are only supposed to be investing in short-term U.S. government debt that has a very liquid market. So it seemed to me that you overlooked one particular risk, which is the legal risk, which I know has been addressed, for instance, by the Bank for International Settlements in its recent guidelines of, I think, about 3 weeks ago. So I was wondering if you could address that.
Sure. I did not go through the entire litany of the risk controls that one evaluates with respect to derivatives. Those traditionally are identified as credit risk, the risk that a counterparty will fail, market risk, the risk that the product that you're trading will move significantly, operational risk, the risk that your own data processing facilities will not be up to snuff with respect to the evaluation of a product, as well as legal risk, the legal uncertainty that a contract that you've entered into will not be upheld. I certainly would not want to underestimate the significance of any of those risks, and in fact, they're all very important. With respect to the particular case you mentioned, for obvious reasons, I won't comment one way or another about that risk or that case. The legal risk was most dramatically underscored in a case in the United Kingdom called Hammersmith and Fulham, and in that case, certain contracts were, I believe, held to be invalid, and if I recall correctly, it was done on an ultra vires analysis. But I, again, won't comment on the Maryland case, only to underscore that highlighting the importance of making sure your contracts are legally enforceable is something all the regulators are concerned about, including the bank regulators.
The other question, Mr. Becker?
Yes, one more.
Please identify yourself.
I'm David Kleinbart from Bloomberg News. Do you feel that retail investors in government bond funds and in money market funds currently have the information they need and the tools that they need to make an intelligent assessment of how derivatives in those funds would perform if interest rates changed?
I'm going to decline to give you a specific answer to that question, and the reason I'm going to do it is in deference to Barry Barbash, the director of our Division of Investment Management that's responsible for that particular area. I think it is fair, however, to at least note that I think we've been very active and continue to be active in trying to evaluate whether there's more that can be done to ensure that people understand what can happen in changing interest rate environments.
Thank you.
Any other question?
My name is Lloyd Miller, and I'm just a member of the club here. As an investor, individual investor, just trying to learn a little more. Like me, could you give either an actual example, or perhaps if you'd be more comfortable with a hypothetical example of what has caused these recent disasters that we've read about in various mutual funds or money market funds and prominent firms? I have been reading and having difficulty understanding what is really causing these things to happen.
Well, that's a fair question, and I appreciate your kindness in letting me try and structure it as a hypothetical, because the underlying facts are more dramatic. The simplest way of saying it, without trying to give you a transactional example, is that some people bought products, the returns of which presumed either steady or declining interest rates. And then interest rates go like this, and the value of the product goes like this. That is my simplest way of saying that if when you strip away all the mathematical sophistication and the estimates of prepayment risk, will lots of people pay down their mortgage, how will the yield curve look, it can get very interesting and great 3D color charts and everything. But if you're making an assumption about the direction of interest rates, implicitly or explicitly, and that assumption proves wrong, you can lose a lot of money very quickly.
Time for one more question. Anybody?
Robin Meredith with the American Banker. Can you just give us an overview of banks' involvement in derivatives, and particularly focusing on how much of it is trading activity, how much of it is investment, and how do you tell the difference when the bank says it's hedging?
Well, having deferred to my own colleague at the SEC, I will certainly not poach on my friends at the bank regulatory agencies other than for some of the more general information. Banks are key players. They are very active in these markets. If anything, banks are, to some extent, dominant players. It reflects their traditional involvement in credit judgments, their traditional involvement in the currency markets. Many of these products grew up in the currency markets to try and deal with currency fluctuations and better manage those risks. Trading versus hedging is a very difficult question, which I think is in some respects hard to measure. And with respect to what's a hedge, it's always important, in my view, to ask whether that's a static hedge or a dynamic hedge, i.e., are you in a position where, irrespective of what happens, you can sit still and basically you've got offsetting positions? Or are you in a position where what you mean by hedge is I have a plan? Because if what you mean by hedge, and that's what usually dynamic hedge means, is I have a plan, that when interest rates go this way, I'll sell this, and then I'll go to wherever. That's a different kind of hedge. So it's important when you talk to people about all these positions are hedged out, all of these positions are managed on a portfolio basis, all of these positions are subject to rigorous examination for what our counter hedges are. You've got to pursue what kind of hedge does that mean, what kind of activity do you have to undertake, when do you have to undertake it. Now, having said I have a plan is in part a hedge, that doesn't mean that's a bad way to manage your business. We do that all the time in our personal lives. We have all sorts of plans about what we would do, about how we're going to finance our children's college education, etc. The world's an uncertain place, and having a plan is a lot better than not having one. But it is different than being able to sit still through the storm.
Thank you very much, Mr. Becker. I hope you can listen to some of the rest of the discussion. Our next speaker is Robert R. Levine. He's Vice President and Treasurer of the Student Loan Marketing Association. Sallie Mae. In 1985, as a Director of Capital Markets He was responsible for the corporation's involvement in interest rate swaps and derivative products. He's a graduate of the University of Michigan, got a BA in 1977, and George Washington University, an MBA in 1980. Mr. Levine.
Thank you very much for having me here today. I guess as an end user of derivative products, I'm very excited, even though I might not look like it, about getting the opportunity to perhaps clarify 2 points. One point that I hope to clarify is to bring some perspective to the numbers. Everybody's heard a lot about the large numbers in derivatives, and I think one of the examples that I'll be able to go through will help shed a little light on that matter. And the second is that for corporates that use these tools as hedging instruments, they have their place. And for people who tend to speculate, there's no way any of us are going to be able to help them. So if I could please get my first slide up, I'll try to help paint this picture a little better. At the risk of oversimplifying things, this might not look too impressive at the start, but this is really 20 years of financial history. I'm sure you've all reported on much of it. 1973 is important because that's when Sallie Mae was chartered to help keep liquidity in the student loan markets. But of particular interest to me is the peak. It's actually when I first started working. I think I've lost my ability to point, but there it is. At that peak in 1981, somewhere in there, the prime was well above 20%. Everybody was very concerned. Clearly, anybody who had lent long and funded short was in a lot of trouble. And that isn't just single A credits or, non-investment grade credits. That also stood for some AAA credits that we're all pretty familiar with. It was a very difficult period of time. And the curious thing is that during this whole period of time, we've got the red line on top is the yield on Sallie Mae's assets, and the blue line underneath is the cost of our liabilities. And what I'm trying to illustrate here is that we had an approach to asset liability management that we called match funding from very early on. I think the significant thing is that all of our assets floated. They were indexed to the 91-day T-bill. So our primary objective was to get all of our liabilities to float relative to the same index. That was our sole purpose for ever entering into derivatives. Well, it was easy getting from 73 to about 1981 because we had borrowings from the FFB Bank, the Federal Financing Bank, at 91-day bills and a very attractive financing level to get us started. So we had a perfect match already. But in 1982, with all due respect to my friend Chip here, the investment bankers were not exactly saying to Sallie Mae, we're very concerned about you maintaining your asset liability match. They were really telling us we've got fixed rate debt you can do, and we've got zeros, and you name it. Everything but debt that was issued to the 91-day bill. So from the very beginning, we had a little bit of a problem because we didn't want to take on the basis risk implied in having floating rate assets and potentially fixed liabilities. That didn't excite us. So in 1982, we actually entered our first interest rate swap. We did a fixed rate debt issuance. We had a corporate counterparty. We really didn't know what we were doing. We knew we were hedging. We'd never done it before. There were incredible amounts of documentation, as I'm sure these fellows can tell you about. And what we had to do was read through every page of it, go through every detail, and if any of you really want to ever learn about swaps, please take a look at some documentation, and I guarantee you'll fall asleep in about 5 minutes. It's not the most exciting stuff in the world, but I think the point is that it's so detail-oriented that anyone who negotiates a swap on their company's behalf is going to really understand what they have gotten themselves into. And that's why I do happen to think that it's extremely valuable to go through all the terms and all the documents on your own. And all I can really tell you is that from 1982 through 1993 in this graph, you can see there was always a margin between what our assets yielded and what our liabilities yielded. And these are not exactly simple times. We had a rather significant crisis in the financial industry in the late 80s, and still Sallie Mae had a rather wide margin of earnings. I think that derivatives for us played an extremely large part in that, simply because we stuck to this rather simplistic discipline of asset liability matching. If we had an asset that we wanted to put on our books, maybe we were lending a bank money to participate in the student loan program, and our only source of funds was LIBOR, well then we lent LIBOR. If we were going to lend fixed, then we borrowed fixed. And it's really as simple as that. And the other thing to remember is that, just like in my first example, the bankers are not always showing the issuers what the issuers really want in terms of funds. Sallie Mae just did a yen transaction a few weeks ago, and it's not because Bob Levine was out looking for yen. To find currency, but I don't have any use for yen. Student loans are not indexed to yen. But thanks to a currency swap with a highly rated counterparty, I was able to transform the yen into U.S. dollars. And not only that, I was able to transform those U.S. dollars that would have been fixed into floating. So that's, from an issuer's standpoint, very valuable for me. If I could just get the next slide up. This slide is one that I hope will begin to give you some perspective for the numbers. I do have hard copy of this, so you don't have to draw circles on your notepads. And I'll give it out to you at the end. What you hear about is on the left. It's the notional amount. And I don't know how an issuer can do any more for you than show you their whole book. I don't even show this to Wall Street. But I'm happy to show it to you all. We've got, right now, a book of a notional derivatives of about $31 billion. It's a rather staggering number, I know. But my main point is, and what people want to try and remember here, is that it's who you play this game with that's important. And this is the credit risk that was referred to earlier. And I think that if you take a look at this, let's start dissecting it a little bit. An enormous percentage of our book is done 34% with AAA counterparties. The second, AA counterparties comprise almost 18%. Of the single A's, you might take a look at that and say, well, Sallie Mae is taking on undue risk here. And I would say that perhaps you're right, but not quite, because I think the thing that insulates us from the risk in the single A category is this footnote that 81% of all the business we've done with single A counterparties is collateralized by government securities. So to the extent that a position moves against us, in other words, we would get U.S. government securities, or perhaps at times we've asked for securities that are highly rated corporates. And so I think what you end up with in this situation is a book that is about 52% AA and AAA all by itself. And then if you consider the effect of the collateralized single A portion of the book, you start to get very comfortable with those numbers. But those are still not the numbers that I prefer to manage by. The numbers I prefer to manage by are the ones on the right, and that is, at any point in time, how much exposure do I have on this notional amount? So you'll hear reported billions and trillions in the swap markets. In our particular case, we have a little over $600 million of current exposure. That would be if I did an interest rate swap in an environment where rates moved from 4% to 6%, that couple hundred a basis point adverse move against me would be a way that I could accrue exposure. And in this particular case, I would encourage you to simply scrutinize that one more time. So what we have here is $637 million of exposure on a $31 billion book. That is 2%. 2%. And of that 2%, I've got almost 41% of it is exposure to AAA counterparties. 16% of it is exposure to AA counterparties. And once again, I have 42% exposure to single A counterparties, but 80% of that is collateralized. And if you're going to collateralize something with government securities, that makes me comfortable enough to say that I would put that in the AA and AAA counterparty risk bucket, if you will. And that's really the way I tend to get comfortable with these numbers. I think that if you don't scrutinize the numbers this way in terms of the credit exposure, you might get a little bit more concerned about them than you should. And I know from our perspective, we've been in the swap business now for over 12 years, and we have never incurred a material loss. We've only got one position right now out of 789 positions that we've done over the last 12 years that involve 78 billion total notional. We have one position where we stand to lose some fraction of $1 million. I can't even put that loss in percentage terms for you, so I won't. And nor will I put the savings that we have accrued over the last 12 years in any kind of terms for you, because I don't think it's good for perspective. I don't think it's particularly constructive. I think the best thing you can take away from this discussion is the fact that our earnings didn't vary at the margin, and that's what gives me the most comfort. And I'll just conclude by saying that I think the work that the G30 has done has been excellent. These are people who have true fixed income experience, and they're trying to help these markets develop standards that will enable them to continue going forward with as little disruption as possible. I also think ISDA has been very helpful in standardizing documentation so that people have a little less to look at each time they do a trade.
Thank you very much, Mr. Levine. Anybody have a question for Mr. Levine now? If not, thank you very much, sir, and I hope you can wait with us for afterwards. We'll have some questions later. Our next speaker is Ernest C. Chip Goodrich. He's a managing director in the Debt and Equity Markets Group of Merrill Lynch and Company. He's vice chairman of the International Swaps and Derivatives Association and a member of the Securities Industry Association's Committee on Swaps and Over-the-Counter Derivative Products. Earlier, he practiced corporate and banking law in New York City, London, and Bahrain. Mr. Goodrich.
Thank you. I'm sorry Brandon wasn't here to hear Bob's comments about the way they run their business. It's a little bit, when Brandon said, I have a plan, is the hedging strategy. I think he was suggesting, well, maybe I'll think about it later. I think Bob demonstrated that end users have a careful and disciplined approach to these products. And one comment on losses and default experience. Bob indicated that on their portfolio of 30 billion or so that they had one default. We have a portfolio of around 700 billion as a dealer, obviously much larger. We have had about 4 defaults in our history of 10 to 15 years in this business. So I think that's instructive about the way people approach this business. The discussion of derivatives in the press and in other public forums has frequently portrayed our business as a fringe activity conducted in a shadowy world of cyber finance. Alternatively, derivatives dealers appear as large carnivorous creatures preparing to run amok in the jungle of world financial markets. President McDonough of the New York Fed this week referred to all of this as derivatives angst. I would characterize this as a tendency to demonize derivatives, and it constitutes a dangerous misperception of these products in today's financial markets. Derivatives today are a fundamental component of finance in an increasingly complex, sometimes volatile, and interdependent global economy. Our products provide essential risk transfer mechanisms to a large and expanding group of responsible and prudent corporations, governments, financial institutions, and institutional investors. That's the reason for their rapid growth over the last few years. The products work for our clients. Much of the adverse press has focused on the losses, and some of them are substantial, incurred recently by a handful of U.S. corporate end users. This is another facet of the demonization of derivatives, the tendency to blame our financial instruments for the consequences of structural, economic, and market changes or underlying market volatility. Some of the end users taking accounting losses on derivatives positions were happy to place the blame on the derivatives demon. It sounded as if they were saying the devil made me do it. On the contrary, as one central bank observer has put it, the introduction of financial derivatives is only one of many changes in financial markets that have occurred in recent decades, including financial deregulation, the evolving role of securitized debt markets, stronger integration of the international economy, and greater cross-border links between domestic markets. The issues raised by derivatives are unlikely to be unique and must be considered in the context of broader financial changes. This observation recognizes that derivatives are more properly characterized as a response to structural changes in the nature of financial markets and not a factor contributing to these changes. Derivatives are simply tools to shift or exchange financial or other business risks. As one commentator stated, they are inanimate. Their power and their appeal results from the ability to cause that transfer in a particularly precise and efficient manner. Now, the tendency to demonize derivatives also provides cover to policymakers, reluctant or unable to confront more basic questions about the structure of financial regulation in this country. As investment and commercial banking businesses become less and less distinguishable, and as competition becomes more and more global, issues such as banking powers, the currently complex system of banking, securities, and commodities regulation, and the proper role of deposit insurance in our economy ought to be the subjects of the policy debate. Instead, attention is diverted from these underlying and difficult policy questions by focusing on the derivatives demon. The confusion about derivatives starts at the definitional stage. The term derivatives has been used to cover a broad variety of financial instruments, including exchange-traded futures and options, certain mortgage-related and other structured securities, and our own area of interest, which is swaps and related over-the-counter risk management transactions. I'll use the swap generically to cover transactions that have the following characteristics. They are privately negotiated contracts between one party, an end user, seeking to exchange or assume a financial or business risk from another party, a dealer. The dealer tries to profit by efficiently managing these risks in ways that are not easily accessible to or too complex for the end user. While these private transactions have a vocabulary of common economic terms, they can be very precisely designed to transfer the client's economic risk to the dealer in exchange for the exact risk or return that client wishes to assume. This distinguishes swaps from certain economically similar products, such as exchange-traded futures, which must have standardized terms. That's because of the nature of exchange trading and the openness of such markets to all interested parties, regardless of their credit quality. Because they're entered into directly between a dealer and an end user, and because they are financial instruments whose value change over time, swaps do involve exposure to the continued performance of the other party. Again, this can be contrasted with exchange-traded derivatives, where credit risk is largely eliminated because of the intermediation of a clearinghouse and the use of daily margin. While swaps and securities markets are closely related, swap transactions are generally not legally or economically securities. They're risk transfer mechanisms. Securities are used to raise capital. In the early days of the market, swaps were primarily liability management tools, as Bob has described. A borrower could create a synthetic liability more cheaply than had it financed directly in the market, providing the desired form of liability. For example, a user of the commercial paper market might be able to beat its usual cost of commercial paper funding by financing, say, in the Swiss franc bond market and swapping back into a commercial paper-based liability. Swaps quickly developed into a flexible and versatile liability management tool which enables balance sheet managers to alter an institution's liability mix and more accurately match the financial characteristics of its assets and liabilities. An understanding of the potential of swap techniques has also fueled their growth beyond their original home, which is the fixed income markets. Liquid and active swap markets have for several years existed to manage commodity and equity price risks, and swaps are used today for management of exposure to other business risks, such as changes in credit risk pricing, real estate pricing, and inflation levels. Today, swaps are used by every major U.S. corporation and financial institution, and by many institutional investors and money managers. In addition, swaps are used by sovereign governments in their fundraising and debt management operations, by government-sponsored entities, as we have heard from Bob Levine in some detail, and by multinational institutions. In short, swaps have become inextricably intertwined in the process of capital raising and the management of financial and business risk around the world. We in the swaps business can, I think, take justifiable pride in the way the market has developed. Virtually every commentator in our business, including the hard-to-persuade General Accounting Office, has recognized the economic utility of our products and the careful ways in which we have identified and controlled the risks attendant to running a derivatives dealing business. The lack of a major life-threatening problem in our business has resulted primarily from market-imposed disciplines and secondarily from private sector initiatives. Given our record, we are therefore skeptical about the need for and potential effects of product-specific regulation for our markets. The Financial Times recently reported on some consequences of product-specific regulation in the United States. It noted that U.S. federal law now prescribes that the following notice be affixed to America's roller towels, which are the things in restrooms that continually revolve. It said, instructions: pull towel gently with both hands. Wipe hands and face. 3, warning: do not attempt to hang from towel or assert your head into the towel loop. Failure to follow these simple instructions can be harmful or injurious. The next day, the Financial Times also reported that screwdrivers are on sale in the U.S. complete with stickers on the handles advising, do not insert in ear. We in the swaps industry are hopeful that policymakers and press will conclude that our products do not require health warnings of these kinds. Thanks.
Any questions for Mr. Goodrich? Please come to the aisle.
I'm David Kleinbart from Bloomberg. If one of your institutional customers wanted to enter into a swap transaction that your experts believed was unwise or not consistent with the goal of the customers in terms of managing the fund or managing the corporation, would you allow them to enter into the transaction on the theory that they're an institution, they're supposed to be sophisticated, they're supposed to know what they're doing, and it's not your place to tell them, what their business is?
The process of discussing transactions with customers is a long dialogue. It goes back and forth, and it is, in many senses, a collaboration. We propose ideas to customers, they react. The ultimate transaction can be a combination of both, thinking on both parts. Frequently, we're in positions where we may disagree on the particular market view that the customer is taking. But in many cases, we wouldn't presume to disagree with that as long as we believe that their evaluation of the market view was thoughtful and after appropriate dialogue and discussion.
Do you ever remember an occasion where you outright refused to enter into a transaction because you felt from conversation with the customer that they just were not sophisticated enough to understand what they were doing?
Swaps are a mature market today, and the nature of our clientele is generally one that is sophisticated, people that we have a long relationship with. And it's rare that those situations would arise for our customers. I've been involved in situations where, a handful of situations in which we've declined to do a transaction, yeah.
Thank you.
Any other questions for Mr. Goodrich?
Robin Meredith from the American Banker. You seem pretty convinced that the market is doing a great job with derivatives, and yet we've seen some pretty huge losses that are being blamed on Wall Street or on banks that sold derivative products. If these products aren't really scary, there's nothing there, and we're all demonizing derivatives, why isn't there better disclosure, and why isn't it the market pushing for better disclosure?
I think the answer is that the market is pushing for better disclosure. As derivatives become a more important component of the balance sheet of financial institutions, I think a lot of people are calling for better disclosure, whether it's equity analysts, credit rating institutions, and counterparties. So the market itself is pushing for better disclosure, and I think, there are private initiatives. The accounting standard setters are involved in a process to have enhanced disclosure specifically on derivatives, and I think that the market is looking to better portray the risks that derivatives pose to financial institutions.
Any other questions for Mr. Goodrich? If not, you have a question, Brad.
Tony Wickren, Executive Intelligence Review again. Standard & Poor's Credit Week, June 13th of this year, they have a report on the trading dependence of the major investment and commercial banks, not just in the United States, but in so many other countries also. And I was wondering if you could comment on what role the use of derivatives play in the proprietary trading. For instance, on just to give you a figure for Merrill Lynch, according to Standard & Poor's, 28% of their profit, I assume, is dependent on trading revenues at this point. That's for fiscal year 93, I assume.
I think that points out one aspect of disclosure which we can begin to see improving. Mixed in trading revenues are results from derivative activities. But I think it's important to distinguish between so-called proprietary trading and derivatives market making. in derivatives market making, we attempt to provide a service to our clients and to profit thereby. We don't look to take significant amounts of market risk in our derivatives portfolio. There are other parts of the firm, of our firm and other firms that may seek to do that, but the derivatives dealing area is not one. As disclosure is enhanced and made more pointed, I think we'll have a better picture of how derivatives dealing activities contribute to the risk profile and to the earnings of banks and securities firms.
One last question from Mr. Goodrich. If not, thank you very much, sir, and I hope you can wait with us and discuss some issues at the end. Our next speaker is John P. Davidson III, Principal and Head of the Global Derivative Services Group of Morgan Stanley, the global investment bank, which has customers on 5 continents and trades on more than 50 exchanges. Before he joined Morgan Stanley, he ran the clearinghouse division of the Chicago Mercantile Exchange for 10 years. Mr. Davidson.
Thank you very much. It's a pleasure to be here today. I'd like to confine my remarks to those and a brief explanation of listed derivatives. Although Mr. Becker noted that the current focus is primarily on the over-the-counter derivatives, not very distant history suggests that that focus can change from time to time, and I think it's important for all of you to acquire a good understanding of the listed derivatives, which really work hand in hand with over-the-counter derivatives as risk management tools. I'd like to focus on 5 points. First of all, I'll talk a little bit about characteristics of listed derivatives, talk about a brief history of listed derivatives where we will discover that while the title of this program presupposes some newness to these instruments, they are in fact very old. Third, I'd like to talk about the regulatory environment for listed derivatives, talk about the uses of listed derivatives, and finally turn to some brief discussion of risk management issues for listed derivatives. Exchange-traded futures, options, and options on futures are really a subset of derivatives which are usually referred to using stock market parlance as listed derivatives. That is to say, they are listed on an official exchange somewhere in the world. Their specific characteristics include the following. They are necessarily traded on an exchange. And for example, in the United States, they may not, in the case of futures and futures options, be traded anywhere else. So while 2 of you can go into the corner and privately negotiate a transaction in which you exchange some amount of dollars for 100 shares of IBM stock, you may not go into the corner and enter into a similar privately negotiated transaction with respect to a futures contract on anything from Eurodollars to soybeans. Those have to be traded at an exchange in the United States or overseas. There are, as a number of speakers have mentioned, highly standardized contract terms. So they lack the ability to customize transactions to the need of the particular customer. For example, the Eurodollar futures, which is currently the most actively traded exchange-listed derivative in the world, are a standardized contract of $1 million on deposit in a major bank in London, priced 90 minutes apart on the Monday prior to the 3rd Wednesday of each calendar quarter month. They are very specific in their terms, and the exchange determines the characteristic of each of these derivatives, and anyone who trades that derivative is trading that specific instrument, not an instrument which is variant upon that. As a result of this standardization, listed derivatives, particularly the successful ones, are characterized by very high transaction volumes. The Eurodollar contract, the Chicago Mercantile Exchange has traded up to 1 million contracts in a single day, representing $1 trillion in notional value. In contrast, when Morgan Stanley does over-the-counter derivatives, if we do 12 transactions with customers in total on a single day, that's a fairly busy day in the over-the-counter derivative market. The standardization allows high transaction volume. Listed derivatives universally, regardless of where in the world you find them, are cleared, margined, and settled by a clearing organization. In other words, there's a central counterparty which assumes the risk of all the direct participants in the market and allows those participants to examine only the creditworthiness of that central counterparty rather than each other's creditworthiness and making decisions about the marketplace. That provides efficient pricing of these listed derivatives. Finally, they are subject to very specific rules and regulations and have been for some period of time. A result of these characteristics are a set of advantages as well as disadvantages. Primary among those is the fact that there is a very limited number of instruments. There are probably fewer than 100 truly successful futures and options contracts in terms of index options in the world today. If you add individual stock options, you of course substantially increase that number. Whereas in the case of derivatives, almost every single transaction is specifically custom tailored, so there are a lot more instruments. There is, as I mentioned, standardization, which has as its value the ability to publicly price these instruments and the ability to know exactly what you're trading. On the other hand, there is no ability to achieve the customization which you get with an over-the-counter derivative. So there may be an assumption of not inconsiderable risk if you are using a standardized instrument to hedge against the risk of a very peculiar type of exposure that you have. In those sorts of cases, an over-the-counter derivative would be much preferable. Liquidity is a value with respect to these kinds of instruments. Because of their high transaction volume, it is easy to enter the market and it is easy to exit the market. You're not dependent on finding a quote from a particular dealer that's active in that particular instrument. You can go to any of the clearing members of the exchange to unwind a position which you've put on. And finally, as Brandon mentioned initially, these are transparent markets. The rules and regulations which govern them are essentially the same rules and regulations, or very similar to those which govern stock trading in the United States and abroad. Briefly, the history of derivatives. Commodity exchanges in the United States go back a fairly lengthy period of our history. The Chicago Board of Trade was established in 1848 and is trading some of the same contracts today that it did when it was founded. The Chicago Mercantile Exchange was established in 1919, although it has its antecedents in the 1890s. And overseas, the history of listed derivatives is even older. The oldest known case of a listed derivatives contract was at the Osaka Rice Exchange in the 17th century. Financial futures and options, which have captured most people's attention recently, started in the early 1970s. Their intellectual antecedents grow out of some work done in the economics department in the Graduate School of Business at the University of Chicago in the late 1960s and early 1970s. The first listed financial derivative was the currency contracts formed on the international monetary market in 1972, just after the failure of the Bretton Woods Agreement by the Chicago Mercantile Exchange, working closely with Milton Friedman, the noted University of Chicago economist. Stock options and subsequently index options began at the Chicago Board Options Exchange in 1973. So these instruments are at least a couple of decades old with respect to the most prominent financial instruments. In the 1980s, these listed derivatives really became global instruments. The large exchange in London, the Life, was established in 1982. An exchange in Singapore, the CIMEX, was established in 1984. And currently there are futures and options exchanges in every single major financial center around the world with no exceptions. 1993 was a significant year in terms of the globalization of listed derivatives, in that 1993 was the first year in which there were more listed derivatives traded outside of the United States than inside the United States, and that trend will certainly continue. The growth in listed derivatives, however, has been a direct function of the tremendous growth in the over-the-counter derivative markets. Briefly, the regulatory environment for listed derivatives is much more established than it is for the over-the-counter derivatives and has rather longer historical antecedents. With respect to securities options, be they index options or options on individual stocks in the United States, these trade exclusively on securities exchanges. Each of the securities exchanges in the United States, with the exception of the one in Cincinnati, trades options as well as stocks, and they are regulated exclusively by the Securities and Exchange Commission. Futures and futures options in the United States trade exclusively on one of 11 futures exchanges and are regulated by the Commodity Futures Trading Commission. Trade practice conventions, contract terms, sales practices, and settlement procedures are all very highly regulated by the exchanges and by these individual government organizations which have oversight authority. Arbitration procedures, including the ability of customers to arbitrate a complaint against a broker or a member, are very well standardized and follow the convention that the stock markets use. Outside the United States, the regulatory environment is largely similar, although typically there is a single market regulator instead of the bifurcated structure that we have in the United States, with an exchange playing a key role. Trade practice and settlement procedures overseas, again almost universally, are highly regulated. Sales practices and contract terms are regulated to various extents in varying marketplaces. There are some limitations imposed by U.S. regulators on the ability of U.S. investors to use certain overseas markets. With respect to the uses of listed derivatives, it's important to understand that the vast majority of users of the listed derivative instruments are financial intermediaries of various types. The most prominent type of user of listed derivatives are derivative dealers themselves, either on behalf of customers or on their own behalf, hedging their exposures in other markets. Broker-dealers, commercial banks, insurance companies, investment companies, and pension funds are also all users of listed derivatives, both in this country and overseas. In the United States, we have a very good grasp on the users of listed derivatives because each of the exchanges and each of the regulatory organizations have what are known as large trader reporting requirements, where everyone with a position over a certain relatively nominal size in each of these instruments has to report his identity or her identity to the exchange and to the government agency on a daily basis and the size of that position. The retail use of futures markets and options on futures is relatively very small. Securities options retail use, particularly options on individual securities, is somewhat larger, but certainly not nearly as large as the general security markets as a whole. What are some examples of uses of listed derivatives? Well, the traditional example dates from by the use of agricultural producers of these futures markets. Those are the markets that they were originally intended and developed for. If you take an example from the state in which I grew up, Kansas, we have a considerable number of wheat farmers. A wheat farmer has risk that from the time he plants his or her wheat into the ground and the time it matures and harvests, the price that is available in the marketplace for that wheat may decline dramatically. They can hedge that risk by entering into a futures contract. If, for example, they were fond of they were going to harvest their wheat in December and they liked the current price at the Chicago Board of Trade of wheat for December delivery of $3.32 a bushel, they would sell 2 futures contracts representing 10,000 bushels of grain, and that would guarantee that regardless of what happened to the price in the cash market for wheat, they would receive $3.32 for their wheat at the time of harvest, because for every increase in the cash market, there would be an offsetting change in the price in the futures market, and their transaction would essentially be locked in or hedged. Now, that's not to say that there isn't risk there. They no longer have risk on the outright price of wheat, okay? But it's important to understand when looking at derivatives that there are other sorts of risks involved. For example, a farmer will tell you that the price of wheat available at the combine head in Kansas is a different price than is available at the grain elevator in Chicago and Toledo. And the standardized contract is for delivery of wheat at a grain elevator in Chicago or Toledo. So that price change, the difference in the price between Kansas wheat and Chicago or Toledo wheat, the transportation costs associated with getting the wheat from Kansas to Toledo or Chicago, is a risk which that producer still faces, and they have to be aware of that. That's what's called basis risk. Another example is a pension fund manager. A pension fund manager might use listed derivatives on, say, the S&P 500 futures contract because he or she anticipates the receipt of a payment from the corporation for whose employees they run the pension fund at a particular point in time. So if these payments are, as is typical, monthly or quarterly, and they believe the valuation of the stock market due to whatever research they've done is ideal today, they can lock in the current return on the stock market by purchasing, in the case of $10 million, anticipated 44 contracts of S&P 500 futures for the September delivery, and they will have today their exposure to the stock market, which they otherwise could not achieve by buying the individual stocks until the $10 million was actually received from the underlying corporation. Now, if you happen to be the manager of the baseball pension fund, you've got a little problem, right? Because you anticipated that you'd have a particular inflow of funds. You hedged that inflow of funds and got your exposure to the market, which met your objective, your investment objective. But the funds never showed up because the owners decided for whatever reason that they weren't going to make that payment on that particular time. Now you have increased your exposure to the market rather than decreased your exposure to the market. So the fundamental lesson for users of listed derivatives or derivatives of any kind is that you have to constantly monitor your position and your exposures in these markets. Now, listed derivatives provide particularly good advantages in doing this sort of risk management by virtue of their characteristics. Like any investment, return is a direct function of the risk taken. So if one is happy with seeing returns in excess of the Treasury bill rate, one ought not be too surprised when there are losses in excess of the Treasury bill rate. The public nature of exchange-traded instruments provides these risk management advantages. For example, volume in open interest is published daily in all of the major newspapers in the United States. So you can get a sense of what liquidity is available in the marketplace and who the size of the positions of the other major participants in aggregate terms. You know how big the market is. You can assess the probability of the market being there when you need to exit. Pricing is real-time and available from any of several dozen quotation vendors. Prices are disseminated by the exchanges. They are arrived at through a public auction market. There is valuation in a central marketplace and nearly universal access to those prices. So there isn't any doubt about the value of an exchange-traded instrument. Finally, you can use those publicly disseminated prices about standardized exchange products to imply prices for customized over-the-counter products, and in that way have a better view towards how to manage your over-the-counter portfolio. But again, the key component of risk management for these products is the need for relatively continuous monitoring. Be happy to take any questions.
Questions for Mr. Davidson? If not, thank you very much, Mr. Davidson, and we'll hope you can be with us later. Our last speaker is Craig S. Tao, Vice President and Senior Counsel for Securities and Financial Regulation of the Investment Company Institute. ICI is the trade association for the mutual fund industry. Mr. Tao oversees the Institute's work on regulatory and legislative matters on both federal and state levels. Earlier, he practiced law with Sullivan and Cromwell in New York City. Mr. Tao.
Thank you. The subject of my presentation is going to be the role of mutual funds in the derivatives market, specifically how mutual funds invest in derivatives. I think this is a subject that has attracted a great deal of interest in the media, and I suppose the reason for that is mutual funds are one mechanism by which retail customers can participate in the derivatives market. I'd like to put some of the controversy in my remarks today that has been generated about the use of derivatives by mutual funds into some sort of context. And I think maybe the best way to start off is to take a look first as to why mutual funds invest in derivatives, and then look at how mutual funds actually use derivatives in managing their portfolios. Essentially, mutual funds invest in derivatives for the same reasons that they make investments in more traditional securities, such as common stock, fixed-rate bonds, etc. They do so because their investment advisors believe that those investments will enable the fund to be better able to achieve its investment objectives and maximize returns to its shareholders. I'd like to give a couple examples of how a fund portfolio manager might want to use derivatives in doing this. Probably the best known example would be hedging, which maybe best comes up in the context of an international fund. A fund that buys a security that's denominated in a foreign currency and doesn't want to have exposure to the risk that the foreign currency is going to decline can use currency forwards or currency futures to try and hedge against that sort of risk while still participating in the company, and so if it's a well-run company, have its hoped for appreciation. In addition to hedging, though, and I think maybe more and more in recent years, mutual funds are using derivatives as investments in and of themselves. They do so in many cases because using the derivatives market can be a more efficient, cheaper, etc. way to achieve a given investment result. And again, I'd like to give a couple of examples. Maybe the simplest is, say, a stock index fund, a fund that seeks to replicate the performance of a well-known stock index. Let's take the S&P 500, for example. When the mutual fund gets additional cash in because investors make additional purchases, it could try and go out and, say, buy small amounts of all the 500 stocks that comprise the S&P 500 index. But it often is going to be more efficient, hold down trading costs, etc., to use that cash to, say, enter the futures market and buy a S&P index futures contract. That way the fund can remain more fully invested and, like I said, avoid some of the costs that would be involved in going into the cash market directly. Another example, say, is a fund that wants to purchase a bond that's linked to a foreign currency or a foreign interest rate because it wants to have that sort of exposure, but there's no issuer in the country in question that meets the credit quality standards that the portfolio manager has. It might try and achieve the result, getting the exposure to the foreign currency and meeting its credit quality standards by buying a structured note issued by, say, a AAA U.S. corporation. It gets the credit quality it wants, and if the note, say, is linked to the Deutsche Mark, it gets the exposure to the Deutsche Mark that it wants. Another example might be a fixed income portfolio manager that thinks interest rates are going to come down and wants to increase its market exposure to interest rates. It could do that in a variety of ways. One would be to lengthen the average maturity of the instruments held in its portfolio. But another way might be to use the derivatives market to lengthen the duration of those instruments. It could do so by buying, say, an inverse floater, a principal-only strip, etc. I think a lot of people have looked at what mutual funds do when they invest in derivatives as being one of two things. They're either hedging, my first example, or they're called speculation. And the implication, often unstated, is that speculation is a bad thing and shouldn't be done. But I hope the examples illustrate that really the reason mutual fund managers use derivatives is no different than why they use more traditional securities. Again, they're trying to achieve the objective of the fund and increase returns to shareholders. Of course, obviously, there's no guarantee that the portfolio managers are going to get it right. Sometimes they'll think rates are going to go down and they go up. Sometimes they'll invest in a common stock that they think will do well, and that company is not going to do well. I mean, that's the nature of the securities markets. Okay, so I've talked about why funds use derivatives. What is the extent, really, of use of derivatives by mutual funds? To try and get a better handle on that, the Investment Company Institute late last year conducted a survey of its members. We surveyed both equity funds and long-term bond funds. We didn't survey money market funds. And we got responses from from funds representing about 75% of all industry assets. They generally demonstrated that the use of derivatives by mutual funds, although it's been growing in recent years, remains quite modest. And I'll give you a couple numbers here. First, to preface it, in his remarks, Brandon Becker went through the difference between using a market value measure and using a notional value measure. We tried to do both. Using the market value measure, which, as Brandon indicated, is probably a better test as to what a mutual fund's current exposure is to derivatives, we found that if you only look at those funds that had some derivatives exposure, it was slightly over 2% of their assets were invested in derivatives, both exchange-traded and OTC. If you included funds that had no derivative exposure, it was actually under 1%. Again, we also looked at notional value as well, which was trying to give a rough guess as to say, what is the fund's maximum exposure under a worst-case scenario? There, if you look at, again, only at those funds that did invest in derivatives, it was about 15.5% of total assets. If you include all funds that we surveyed, it was slightly under 6%. I think those numbers probably overstate the exposure of mutual funds, though, because we didn't bother to try and distinguish what was hedging versus what was not hedging, offsetting positions, etc. Just briefly, what types of derivatives did mutual funds hold? Among equity funds, by far the most common were currency forwards and currency futures, which indicates that this was mostly being used by international funds, probably to hedge other positions they held in their portfolio. Most of the derivatives holdings were by fixed income funds, and there, at least looking at market value, the most common types of investments were interest-only and principal-only strips, inverse floaters, and other types of structured notes. Like I said, the survey was done back in late 1993. Trying to figure out where things stand now. My guess is probably through the end of 1993 and early 94, mutual funds were increasing their investments in derivatives as the market continued to develop. I think with a lot of the turmoil in the bond market and some of the losses that you all have reported about, my guess is at least among the fixed income funds, investments in derivatives has probably declined somewhat. Just briefly, what are some of the issues involved for mutual funds that invest in derivatives? Again, I think for the most part, the issues for derivatives are really not that different than issues involved in mutual funds investing in other types of securities. But I think some of the recent experiences that have been reported in the press do highlight at least some areas of inquiry for mutual fund portfolio managers and other people in mutual fund organizations that want to invest in derivatives. I think it probably comes down to two basic questions which are somewhat related. First, when considering whether or not to make an investment in derivatives, the portfolio manager should ask, is this investment consistent with the fund's overall strategy as set forth in its prospectus and other communications to shareholders? And second, is the disclosure regarding the derivatives in the prospectus and the other communications accurate and clearly understood by investors? With respect to the first question, I think it's obvious, I'm sure most of you know, that a mutual fund can only make investments consistent with the disclosure set forth in its prospectus. But I think funds would be well advised, and I think the vast majority do, go beyond that and ask a broader question, which is, are the investments going to be consistent with the reasonable expectations of investors in this fund? To give one example of how that might play out, let's take a bond fund that's considering whether or not to invest in a structured note whose performance is tied to the common stock of another issuer. I think unless there's clear disclosure that this bond fund is going to be taking some sort of equity risk, that's probably not an appropriate investment for that fund. In addition to looking at a prospectus disclosure, I think funds also have to consider their advertising and sales literature as well. If a fund is stressing safety of principal as its investment objective, then certain types of derivative investments probably wouldn't be a good thing for that fund, although they may be perfectly fine for other more aggressive types of funds. With respect to the need to clearly disclose the nature of mutual fund investments, I think the obvious temptation, and maybe the temptation on the part of regulators, is going to be to respond to some of the recent concerns by imposing voluminous types of disclosures detailing every individual type of derivative instrument and the types of risks that they pose. I personally think that that wouldn't be terribly helpful to investors and could actually be misleading. Again, I'll go back to an example. Let's take a long-term bond fund that seeks to maintain an average portfolio maturity of between 15 and 20 years and does so. And the same fund then invests in some inverse floaters that have a duration of, say, 15 years. I mean, you could put in some detailed disclosure about the risks of those inverse floaters and how they'll react to different interest rate conditions, but since in that case, those securities present the same risks as the rest of the fund's portfolio, it's not clear exactly what will have been added by that kind of detailed, specific disclosure. Another suggestion, and at least informally has been raised, is, well, maybe funds should put on the cover page of their prospectus what percentage of their portfolio is in derivatives. I'm putting aside what I think is a very difficult question, exactly what is a derivative, and I don't think even all the people who have talked here today have given a very clear answers to what that is, because in fact there's no real agreement on that. But putting that problem aside, I'm not really sure what sort of information that would provide to investors. As I think my examples have shown, in many cases investments in derivatives can reduce risk because they're used for hedging purposes, or they can at least be not increasing risk because they're perfectly consistent with the risks presented by more traditional securities in the fund's portfolio. So again, that type of disclosure could be meaningless and could even be misleading. I think maybe the best way to look at what sort of disclosure is appropriate was summed up very well last week in the Wall Street Journal. Had an article talking about mutual funds and derivatives. And what they said, the important issue for investors to look out for is not the derivatives exposure of a mutual fund, but what is the mutual fund's overall risk. Certainly derivatives are going to be a component of that if the fund is active in derivatives, but it's not necessarily the whole story. Just briefly, in addition to prospectuses, there are other means of disclosing to investors the nature of their investments in various mutual funds. There's a recently adopted requirement by the SEC to require an annual discussion of of the fund's performance. It's either going to be in the prospectus or in the fund's annual report. Again, a fund that has actively used derivatives and they've had an effect on the fund's performance will be required to include a discussion of this in its prospectus or annual report. Another source of disclosure are the fund's financial statements. And funds, I think, are going beyond what is the bare minimum required under accounting rules and putting additional disclosure in their financial statements about certain types of derivatives so investors can get an understanding exactly what this instrument is, how it will perform, etc. I think disclosure is the most important, but I do want to make the point that the Investment Company Act is a very strict regulatory regime that goes beyond disclosure, and various issues such as restrictions on the ability of a mutual fund to leverage itself, requirements that funds value their portfolio on at least a daily basis, and restrictions on the amount of illiquid securities that a mutual fund can hold apply equally to derivatives. And so they're subject to the same sorts of regulations. There are other issues that come up with respect to derivatives under tax law, commodities laws, etc., but I could be here all day, and I'm sure you don't want to hear about that. I guess if I had to sum up, my basic message here today is there's nothing inherently different or unique about fund investments and derivatives. I think the same issues that have been raised with respect to these investments, the most obvious being how do funds clearly disclose the risks to fund investors, apply to non-derivative investments as well. If I had to guess, as the derivatives market continues to grow, I think mutual funds are going to play a more and more active role as investors and really will be providing to their shareholders the same sorts of services they provide with respect to investments in the cash market. They'll allow investors to participate in the market, which again, like all markets, is going to have upside and downside, but doing so in a diversified portfolio that's professionally managed and that's also subject to strict regulation. That concludes my remarks. I'd be happy to take questions.
Questions from Mr. Kyle? Yes, sir.
Again, my name is Loy Miller, and I'm just an interested individual investor. From my reading of things like the Wall Street Journal, isn't it a fact that a number of these mutual funds that have all of a sudden hit deep trouble because of various uses of derivatives had a risk record that would not have predicted that up until they really hit a real rock in the road there?
Well, I mean, there's two possible responses. It is possible that the fund's prior performance in a period of stable interest rates or declining interest rates was not very volatile, and then when the market changed and you had interest rates going up, these investments lost money. I mean, that's certainly possible. The issue, however, is not whether the investments were, whether the performance was inconsistent with the past performance, because I think it's a basic tenet of certainly securities law that past performance is no guarantee of future results. I mean, that's a very important message that mutual funds have to communicate to their shareholders. So I think anyone who assumed, well, gee, this fund has been up 4% a year for the last 3 years, I guess I can assume that it's going to continue to do so, was making a very serious mistake, and I don't think a very justifiable mistake. The other, I think, more difficult issue is, did the fund's disclosure documents, its prospectus, et cetera, indicate the types of risks that it was assuming by making certain types of investments in derivatives as well as more traditional securities. And that's something that has to be answered on a case-by-case basis. I will say that at least based on the reviews that I've made of fund sales literature, prospectuses, et cetera, I think funds have done a pretty good job overall in disclosing the nature of those risks.
Related question, if you were looking at the area of risk or the probability of risk, isn't it true that a number of these funds and fund companies that have had bad trouble have had them with money market funds, which supposedly should have no risk?
Well, the issue with respect to some of the recent losses in money market funds, and again, no shareholder ended up losing any money, is really not so much a derivatives issue. I mean, money market funds, I think, unique among mutual funds, have restrictions on what they can invest in. They can't cure it by disclosure, in other words. And essentially what a money market fund is required to do under SEC rules is hold only instruments that are both high credit quality and possess minimal market risk. I think in terms of interpreting the specifics of the SEC rules, certain people disagreed as to what sort of instruments were inappropriate for money market funds versus ones that could be in a money market fund portfolio. I guess experience has shown that the people who took the more conservative approach probably were right on that one. But I don't think it's really a derivatives issue. I mean, I think some of the instruments that money market funds held that arguably they shouldn't have held, and the SEC has come out since and said you shouldn't have these in your portfolios, probably wouldn't be considered derivatives at all. They were floating rate notes, and if you're going to characterize all floating rate notes as derivatives, then I think almost everything is a derivative. Conversely, I should point out that there are certain types of derivative instruments that are structured precisely to enable money market funds to meet their regulatory requirements. I think tax-exempt money market funds probably couldn't exist except for things called variable rate demand notes that, again, arguably could be called a type of derivative. What this type of derivative does is reduce the risk and make what would otherwise be inappropriate tax-free investments perfectly appropriate for money market funds.
Any other questions for Mr. Tile? If not, thank you very much, Mr. Tile. But before we go to general questions, I would like to give the members of our panel the opportunity to respond to anything that they heard up here today. I'd like to, starting with Mr. Levine and going on up the line. Would you like to answer or comment on anything then said by another expert?
Not really.
Mr. Goodrich?
I think I'm in the same boat as Bob.
Mr. Davidson?
Passing seems to be the popular option, so I'll pass as well. Thank you.
Well, Mr. Tile?
I'll pass as well.
Any question for any member of the panel? We've all rented individual mics. They don't have to get up, come here. Would you just address your question to the member of the panel?
Well, I guess this is actually for the panel at large. What I did is I took the, not the interest rate, but actually the yield on long-term government bonds since 1927 for every month, which is available from Ibbotson Associates in Chicago, and looked at the standard deviation for 7-year periods. That would be overlapping 7-year periods, 84 observations with a 95% confidence level, and found that the standard deviation actually tripled in the 70s and 80s and actually quintupled in the 80s and 90s. And so, you know, it would appear to me that when you're talking about derivatives, that you're managing risk, that what you're really talking about is the fact that governments around the world have abdicated their responsibility to bring order to the marketplace in order so that firms that produce things and so forth can thrive. And, you know, if you look at the result, I'm not at all happy what's happened to the U.S. economy in the past 20 years. You know, we've had a 13% drop in real earnings by 80% of our population. We're being told we can't afford Social Security and retirement systems. We can't afford a super breeder reactor. We can't afford a super collider. We can't afford a space program. We can't afford to go to Mars. We can't afford anything, it seems, except derivative speculation. Now, the World Bank last year came out with a report that was very controversial within the World Bank, which was on the so-called tigers in East Asia, looking at what the Japan, Korea, and Taiwan had done. And one of the key findings was that they had suppressed the financial markets. So I was wondering, why don't we just admit that this deregulation and free market experiment in the past 20 years has been a complete failure, and we get rid of derivatives and let the government handle the risk instead of having chief financial officers at Caterpillar making mistakes in judgment?
Anybody like to respond to that?
It strikes me that that was the approach we used with the savings and loan institutions in the United States, and my grandchildren will be continuing to pay the cost of that sort of government intervention in the marketplace. No, that was improper regulation. It was not deregulation.
Any other questions for a member of the panel? Yes, ma'am. Would you please go to a mic and identify yourself?
I'm Laurie Itkin with the National Conference of State Legislatures, and our membership recently adopted a policy on state regulation of information services in response to pending federal telecommunications legislation, which would broadly preempt state regulation of information services. One of the pieces in that policy deals with the ability for states to impose disclosure requirements on financial services solicitations over, online systems, including the internet. Can any of you comment on any initiatives on behalf of states to regulate derivatives generally?
Anybody like to take that one? I think that really was a pity we didn't get Mr. Becker to respond to that from the man from the SEC, but he's not here. Would anybody else like to? Well, I believe we passed on that one too. Any other question for any member of the panel? If not, I want to thank you. Well, I think we've heard enough speeches.
Yeah, I know you've heard enough speeches.
Appreciate it very much.
And well, in April of last year, there was a proposal made by a certain economist named Lyndon LaRouche to impose a 1/10% tax on all notional principal amounts, and that was even picked up by the House Banking Chairman Henry Gonzalez. And I was wondering, I have to pay 7 or 8% tax on bread. Why not pay a 1/10% tax on securities and derivatives transactions?
Anybody like to respond to that last question from that gentleman? Thank you very much for a very interesting and useful presentation. And thank you all for coming. And